What's going on, you guys? My name is Zach Hartley, and in this video we are going to compare two very exciting real estate brokerage stocks. The first one is going to be EXP World Holdings, and the second one is going to be the Real Brokerage Incorporated. I am making this video because I personally know several people that work for both companies. They are all over social media and they have fairly similar business models. So I am personally curious about which company is a better investment, is a better corporation, and has better margins. And so in this video, I'm going to share with you all of my research. I'm also going to take a look at the market sentiment and how the overall real estate industry is doing at the end of this video. So make sure you stay tuned and let's jump right in. Okay, so the ticker symbols here are EXPI and REAX. EXP World Holdings is this one here, and then Real Brokerage Incorporated is REAX. And the business model behind these two companies is fairly simple. They're brokerages where the agents, the real estate agents, will sign up to work with these brokerages, and they will sell the homes through the brokerages, and they will also recruit other agents to join them, either on their team or in their corporation. I'm not completely sure how it is structured, but they're recruiting other agents to basically work under them. Now, the company itself, EXP World Holdings and the Real Brokerage Inc., they make commissions when the homes actually sell. So they collect the money, they have the technology and the platforms that help with those transactions, and then they pay out the real estate agent and they take a little bit of money for themselves as well. The business model here is to get more agents, because the more agents you have, the more people that are selling and the more commissions that the brokerage will make. Now, when we take a look at these two companies, they're both operating where I live as well as throughout the majority of the United States here, but they're very different sizes. If you look at the market cap here, EXP World Holdings is a $1.79 billion company, where the Real Brokerage Inc. is a $205 million company. And so EXP has a market cap that is 8.7 times higher than the Real Brokerage Incorporated. Now, there's nothing wrong with that, and they're still very comparable because the business models are almost identical and they're in the same industry, but you need to keep that in mind that EXP is a kind of medium to large size player in the industry, whereas the Real Brokerage Inc. is a very, very small player as of right now. Now, when we take a look at the income statement here, this is the income statement for the last quarter, or at least the first quarter of 2022 here, compared to the first quarter of 2021. You can see that their revenue increased dramatically. This is really nice here. Their total operating expenses were fairly close to the total revenue here, and so they made a little bit of operating income. This is a bit of a red flag here because their revenue doubled, almost doubled year over year here, but their operating income actually went down. So that is kind of a concern here. That's something I would be looking into more. They did generate a profit though, which is very nice to see. They generated $4.8 million last year and $8.8 million this year. However, 5 of that was actually a tax benefit. So that's definitely something to consider here, because without that tax benefit, their net income actually would have gone down year over year. So definitely something to watch for here. They also paid out 91.7% of their revenues in this commissions and other agent related costs. So that is really important. If you're an agent, this company is paying out 91.7. However, one thing you need to note here is that their revenue over the last few quarters has not done very well. Yes, last year it was in that kind of $583 million range. It jumped up to almost $1 billion here, which is really, really nice. But ever since then, it kind of went level right here, and it has actually declined over the last 2 quarters. So that is sort of a red flag here. Their revenue numbers are declining, and so is their income. If you look at net income down here, it went from $37 million here down to 23, down to 15, down to 8. So that is a pretty sharp drop off here, and it's definitely something to be watching for with regards to EXPI. Now, when we look at the Real Brokerage Incorporated, their revenue actually went up by a much, much larger or more significant amount. So EXP, their revenue nearly doubled, but the Real Brokerage Inc., their revenue actually went up by over 6x. So that's really, really nice to see here. They generated a decent amount of gross profit here, but they did generate an operating loss. So this company is not operating at a profit, at least in the last quarter. They are not currently profitable, but they are growing much, much faster than EXPI. So definitely something to keep in mind. And when you look at the revenue here, it actually looks way, way better. They went from 9.3 million to 23 to 38 to 50 to 61, which is just a very, very steady growth trajectory in the exact same time period where EXPI has actually been declining. And so that is super, super interesting, because if this was just a market dynamic and less homes were being sold and it was affecting everybody, we would expect both of these companies to see sort of the same percentages with regards to a decline or an increase. However, the Real Brokerage Inc. is increasing over time, whereas EXPI is declining, at least over the last 2 quarters. So definitely a red flag there from EXPI. However, when we look at the price to sales ratio, it's kind of also an interesting story, because it sort of tells us the opposite. Because the Real Brokerage Inc. is trading at a 1.2 times price to sales ratio, meaning that the price of this company is 1.2 times their annual sales. EXPI is trading at 0.42, which means you can buy EXPI with regards to the price you're paying for it compared to their sales. It is much cheaper than the Real Brokerage Inc. So it is trading at a discount compared to the Real Brokerage Inc. And I think that is because the Real Brokerage Inc. is continuing to increase their revenue, and so people are a little bit more optimistic about the future. Now, when we look at the balance sheets here, they're actually both very, very similar. So the current ratio for EXPI is 1.57, and they have customer deposits of $116 million. Anytime you take a customer's money early, it gets counted as a liability. You'll see this in a lot of recurring subscription softwares where they'll charge an annual fee up front and then give you 12 months worth of access. The money that they charge up front is considered a liability. It's the same thing here when EXPI takes customer deposits. It's considered a liability. However, they're not paying interest on it. They don't owe it back to anybody. It's just for services that haven't yet been rendered. And so that is important here. It actually makes the balance sheet look better than just comparing the assets to liabilities here. You kind of take this out of the liabilities because it's not like they owe that money. It's not like it's a big debt for the company. It's just money that they've received that they can't count as revenue yet, but they need to hold on to it because it's a deposit. And so EXPI balance sheet, very, very healthy. Same thing with the Real Brokerage Inc. Their balance sheet is also very healthy. You can see their current ratio is almost the exact same at 1.58. They do not have customer deposits of $100 million, but you can see here their current liabilities are only $24 million. Their total current assets are $39 million. So it is a very, very healthy balance sheet. They're fairly proportionate balance sheets relative to the sizes of the company. They're pretty much in the exact same cash positions. Now, when we take a look at the stock chart for EXPI, it is very, very concerning because the stock hit a high of $90 right here, and it is now trading at $11.93. So it's down by, let's call it 85%. They have also started paying a dividend. You'll notice these blue dots right here. These are 4-cent dividends. And so very, very interesting strategy here. This is a growth company in real estate that's honestly growing fairly fast year over year, but they're also paying a dividend. I don't quite understand that strategy here. And the stock has taken a major tumble from $90 all the way down to $11.94. It looks like hopefully we should have some support here around $10 to $11. We'll see if that holds up though. Now, when it comes to the Real Brokerage Inc., it's not looking as bad, you could say. It's definitely not looking good in any way. A high of $4.35 down to about $1 here. So they're down by 75, maybe 80%, probably just a little bit less than EXPI. But they also announced that they are buying back shares. So they have filed the paperwork and put everything together to actually buy back 5% of the outstanding shares, which is nice to see. It means that management thinks the price is oversold. They think they're undervalued. They're actually going to use some of that cash to buy back these shares because they think it's such a good deal. So it's a good show of confidence from management. However, the stock so far as of lately has been in a bit of a free fall. Now, when it comes to buying into this industry, getting into real estate, you should probably watch my watch list that just came out because I didn't have a whole lot of good things to say about real estate, and that's because the market conditions right now are a little bit tough. What I mean by that is that inflation in the United States is 8.6%, and Canada is fairly close to that as well. We also have increasing interest rates in both Canada and the United States. The interest rates are going up, and that means that demand could slightly dry out. There could be less demand in the future, and when that happens, if the supply just remained the same, the average home price is going to go down and the commissions that these companies make is going to go down with it. So unfortunately, what these companies want is lots of transactions at really high prices, and what we might see is lower prices with slightly less transactions. We also have concerns about a recession, so if people start to lose their jobs, as companies start to lay people off, which we are already starting to see, this could be a major concern. And if it gets really bad, people might need to sell their house and downsize, which could be good for the companies, but it's still going to be at the lower prices, which is going to have a bearish impact on the commissions that these companies make, because it is based on the home price sales. Now, another factor to look at here is the number of homes that are being sold each year in Canada, particularly. This is just where I live, so I'm using it as an example. You can see that when COVID hit, nobody was buying a home. It dropped to a very low number, like below 2/3 of the 10-year moving average. It dropped significantly, and then it rallied extremely fast because the government cut the rates and everybody could go out and buy a home at 1 or 2% interest, and it was kind of a no-brainer. It was really easy to buy a home. Since then, though, it has started to come back down as the interest rates have started to rise. And as you can see, we are now at our 10-year monthly moving average, and it looks like we could be crossing below it. And as of right now, over the last few months, we're definitely in the downward or the bearish direction. If you zoom into this market and you go quarter by quarter, you can very clearly see this downward trajectory and this downward movement, because April was lower than the quarter before that, and May was lower than April. And so it's really interesting to see. You can also note, I got this information from where I got this chart, the actual, not seasonally adjusted, number of transactions in May of 2022 came in 21.7% below the record that was set the year before. And so the number of transactions in May of this year compared to May of last year is down by 21.7%. Both of these companies make their money on the number of transactions and the price of those transactions. And so it is not looking great for the industry as a whole. However, these stocks have also sold off by 70 to 80%, maybe 85%. So are they too low? Are they too cheap to avoid? And eventually we're going to see a recovery in housing. It just kind of depends on your strategy, but here are my thoughts. Number one, I think you should be buying these stocks when you feel confident in real estate. You should not be doing it before that. If you feel confident in real estate right now, then it's probably a great time to buy. But if you're still worried that increased interest rates will bring down the real estate market, I kind of have that concern right now. It might not be time to buy either of these stocks. However, if you're looking to get into the industry, EXPI has declining revenue and declining profit over the last few quarters. That is a major red flag to me, especially when the real brokerage has increasing revenue and basically better margins over the exact same time period. And so if it was affecting both of them the exact same way, I would say it was an industry trend. But if EXPI is going down while Real Estate Brokerage Inc. is going up, that is just a business strategy move. That is what is happening in the marketplace, and it's going to be really interesting to see what happens in the next quarter, if that trend continues or if it starts to reverse. I also don't understand the strategy at all behind EXPI paying a dividend. It is a growth company that should probably be using that money to turn their revenues around and support their agents more and sell more houses. That is what would make the most sense to me, because I don't think they're at a point where their cash flow is sustainable enough and long-term enough that paying a dividend makes sense. I also don't think people are holding this stock for exposure to the dividend. I don't think the people that work for these companies are holding these stock and buying into it because they pay a nice sustainable dividend. So I just don't understand the strategy here. If you have any thoughts about it though, or you work for one of these companies or you know information about it, please leave a comment down below. I would love to learn more about this, or if I'm wrong about anything, please correct me. I'd love to learn a little bit more about it. But if you're interested in learning a little bit more for yourself about how to manage your own portfolio and evaluate companies like this, definitely check out my completely free Stock Market Fundamentals course. If you sign up with the link down below, you get 1 month of free access to the entire Skillshare platform, where you can take my course that is 10 hours long. It has over 13,000 students that have already gone through the course, and they have left over 400 reviews for you to take a read through and see if it's right for you. There's over 1.9 million minutes of watch time that have already been spent on the course. It is completely free for that first month. It's hosted on Skillshare, and the link is in the description down below. Now, that is it from me. If you got any value out of this video, please remember to click that like and subscribe button. If you have a different opinion, or I missed something, or I said something wrong, please leave a comment down below and I will do my best to correct it. Thank you guys so much for watching till the end, and we will see you in the next one. Good luck trading, good luck investing, and we'll talk to you soon.